Yesterday, that drawdown in inventories gave oil a bit of a boost, but the dollar is rising again today. What direction do you see oil going in today?
I think today is probably going to be a rather boring day. There aren't likely to be a lot of catalysts. Yesterday, of course, we had the Bank of England adding liquidity, which ignited risk appetite across all asset classes virtually. We also had speculation that the Russians are pushing a cut of as much as 1 million barrels for the OPEC Plus producer group. As you mentioned in the report, EIA came in with a significantly lower than expected inventories across the board, about 8 million barrels less inventories in products and crude than was expected, and that served as a catalyst to move things higher. Today, of course, much of that has been priced in, and unless we get some new information, quite likely about OPEC, this could go. But I still think this was mostly a short covering rally yesterday, and that's done. I suspect that OPEC does come up with a cut at their meeting in Vienna, and we could move towards $90. That's where we see resistance at this point. But I think as far as today is concerned, maybe steady as she goes. Probably not a lot of things unless something happens during the day.
All right, $90, obviously not a big move from where we're at right now, at least with Brent crude. I want to talk to you about what may not be priced in. Obviously, China's, recovery from their COVID lockdowns just hasn't happened as fast as people have thought it was. From FedEx to other tech companies just cited that things are slower there and the lockdowns have just kind of hit things there. If and when China reopens, does that completely change the complexion of the oil market?
I think it changes it considerably. Earlier in the year, we were quite confident that China is going to dispense with its COVID zero policy. That hasn't happened, but we are seeing signs that this may change. And as we go forward, China will reopen. It's likely, I think, that OPEC will mitigate some of or reduce some of its production. But the big risk, of course, remains the global macro side, where we could be headed for quite a hard landing. And that means the current estimates that a lot of agencies have of some 2 million barrels of new oil demand next year might not materialize. And if that is the case, if we go hard to the downside in aggregate demand, OPEC will be worried about surpluses. Markets will be worried about surpluses. And hence we have this disconnect still where the futures markets were somewhat more negative on prices than the current supply-demand fundamentals would suggest. So that is still yet to play out, and much will depend on how severe the slowdown is. The Fed is telling us they're going to be very aggressive. We could see the Bank of England to be very, very aggressive as well. Certainly that's what is being priced in. Of course, the ECB and other major central banks. So as China comes out, we could, in the West, be slowing severely and offsetting that. As important as China is, we are still the bigger consumers of oil.